Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement with Grand Rapids resource for a common sense approach to our money, to our planning. Certified financial planning professional Ron Corser, CFP, giving us a little bit of guidance to make sure that every dollar is working its hardest to help us achieve our important financial goals. And we always appreciate the guidance, Ron, because in today's economy, that seems to be no easy task to tackle.
It isn't. And this Memorial Day perhaps brings it a little more into focus on what's real and what's not, and what's important as we celebrate the sacrifices of our military over the past several hundred years. It's a day that's near and dear to my heart because I've had relatives that fought in the First World War, I think the Spanish-American War, certainly World War II, Korea, Vietnam. And so this day is a day that we honor some of those folks that didn't make it back, that give us the privilege and honor of living in what really is truly the greatest country, I think, in the entire history of mankind. We certainly are not without our blemishes, and we're like a giant dysfunctional family, but we're still America, and there's still a lot of good things in this country. And there's an incredible wealth of great people in this country. Not necessarily what we might call those in Foggy Bottom, but just basic Americans. America is really unique, and I know I'm going to go on a little bit, but I really believe this in my heart. America is a truly unique country. We are blessed as a people to be some of the most giving, kind, generous people on the face of the earth. When things go wrong, when there's tornadoes and hurricanes, it seems like the United States is the one that steps up. When there's earthquakes, when there's travesty, the United States, the people themselves step up. It's easy to give money, which is what the politicians always do, but it's much harder to give of oneself. But Americans have an interesting and wonderful habit of doing that, of always willing to pitch in, to go where there's an earthquake, where there's a hurricane, where there's a crisis, a war, and help people. And so I'm really blessed to live in this country. Do we have a lot that we have to fix up in this country? Absolutely. But let's don't forget that this is still the greatest country in the world. I'm very privileged and blessed that God has led me to live here. I did serve my country, and I'm proud of that, even though it was perhaps not the most comfortable experience. But as a country, we're a great country. Our government perhaps needs a little bit of work and a little bit of prayer, but Americans by and large are really great folks. And I hope that as you celebrate Memorial Day, as we all do, with family and friends, that you remember some of those in your family, the neighbors you knew that maybe gave the ultimate sacrifice to defend our country. So go forth and prosper. I look forward to a great weekend. I'm going to try again to learn how to smoke ribs. Just a little personal note of what's going on in the Corser family. I bought a smoker last year because I wanted to become one of those barbecue kings. What I found out is two things. Number one, it ain't as easy as they make it look on TV, even if you read directions. And number two, you got to work at it. And so this summer, I'm going to try again, see if I can figure out how to cook a couple slabs of St. Louis ribs and do some other fun things with family. But as we go forward here, it certainly has been an interesting 5 months in the country. And I tell you, it's just one thing after another, isn't it? On the social level, on the political level, and we have all the confusion and the uncertainty and sometimes the fear of what's going on economically and the markets going all over. Um, I tell people, you take a deep breath, just step back. I don't believe this is the end of the world. I don't think the zombie apocalypse is right around the corner. But we do have some things that we have to contend with, and we're going to talk about that today. And one of the things that we talk about on this show a lot is what about your money? What about your life savings? What do we do with it? What do we do in good times and bad times? What do we do in uncertain times, crazy times? And I would say that we're living in a time now that's good and bad, crazy and uncertain. So what are we going to do? How do we respond? It's not so much what's going on that's important. It's really what our response to everything is. And that's really true in a lot of parts of our life, isn't it? It's how we respond to things. So whether it's good or bad, there's always an opportunity to improve your position, to take advantage of some things. And so we're going to talk about some of that today and some of the things we might do to shore up a retirement plan that maybe is starting to vibrate just a little bit. Or for those of you who have a lot of years to go, what kind of an approach or response should we make to the world around us today? So stay tuned. Give us a call. If you have any questions or want to set up a time to meet with us, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and number in there, and we'll reach out to you and help you with answers or get you material you need.
Again, that number 616-301-2581 to speak with Ron Corser, CFP, a certified financial planning professional, about your money. 616-301-2581. And the team, by the way, they're at Cornerstone Retirement Partners, your resources, Grand Rapids, surrounding areas, proactive savers and investors, wherever you are hearing the sound of our voice or watching this podcast, you can give them a call and speak with them about your money. Ron, my simple question then is, the market's going wonky, I'm losing money. What should my response be? What's an appropriate response when we see times like this?
Well, it makes me laugh and smile a little bit, not because it's such a strange question, but it's one of the most common questions that we talk with our clients about every day, is what should be our response. We know that if we step back and take a long look at things, if we go back the last 110 years, markets have gone up, they've gone down, they've gone sideways. We've had enormous run-ups, we've had enormous downturns, and everything in between. And so the question is, well, okay, right now we've gone through 5 really volatile months. I mean, I remember talking to somebody, one of my clients in the beginning of May doing a review, and I said, you know, the market's down a little over 13%. This was the first week in May. And I said, it doesn't seem that bad. It just seems like this has been a very slow motion ride down. It's not a roller coaster. You know, the markets seem to go up a couple of days and they go down a lot. But as we step back and we look at what's happened, the markets are down. And it's really a strange phenomenon.
Yeah, but Ron, when you see or experience a car crash, that seems to happen in slow motion as well.
Yeah, it can. It really can. Sometimes you just get frozen on it. But when I look back, you talk to people and you say, you know what? The market's down. Like the one account, I remember we had this long conversation with one of my favorite clients. I said, the market's down 13.4%. Your whole portfolio is only down 4.5. Nobody likes to lose money, but we set up your portfolio in a way that it would behave and perform this way in a bad market. So the strategy is working. It's just that we're not making a lot of money right now. And he understood it. He really did. And we've done some other things too to help. So one of the important questions to ask everybody, and ask yourself this, is not what are we going to do? Should we run around backwards or get out of the market, bury it in the backyard, do something like that? But if the market goes up, what's my strategy? If the market goes down, what's my strategy? If the market goes up, is my portfolio ready for that, to take advantage of it? If the markets go down, is my portfolio ready for that, to minimize the losses? These are the conversations we need to have with our advisors, and we have these conversations constantly with our clients. It's not so much what's going on around us, it's what are we going to do about it and how we're going to respond. Now, there's a couple things to consider. First of all, if you're 35 years old and you're saving for retirement 30 years away, somebody says, well, I'm not going to make any changes in my portfolio. I'm not going to do anything because the markets always go up, even though they've gone down. And my response to that is, that's true. The markets do ultimately go up. They always have. Over the last 110 years, the markets have averaged about a 7.5% rate of return, averagely every year. Except when you look at the last 110 years, we've never had an average year. We've never done that. And we've gone through periods, for example, 10 years where nothing happened. 2000 to 2010, the markets were flat. Two big crashes, but flat. 1970 to 80, terrible time in the market, high inflation, some of the things that are going on today. So there have been times when being in the market has been not only painful, but it's created significant losses. So one of the key things that people have to understand, and I encourage everybody to give us a call, and we can help kind of put some flesh to these bony things, is it's not so much that you want to time the market or you want to get out or stay out or get back in. It's about having a strategy of saying, how is my portfolio positioned if markets go down right now? I think it's very easy to say this coming year, based on what we've already seen, is still going to be really volatile. I mean, we have inflation that is not under control, enormous spending. We're in the middle of all kinds of political battles. Government spending is out of control. The Fed, I'm not sure, is in control of anything, even though they want to pretend they are. So you can say, you know what, I'm just going to close my eyes and I'm going to stay the course because I got good stuff and ultimately I'm going to be all right. That's an appropriate strategy. I didn't say good or bad. I said that's an appropriate strategy if you can say yes to the following two questions. Number one, I don't need to take any money out of my life savings to supplement my income. I can just let it ride. And number two, I have invested in some things that I truly understand what the downside risk is for these investments. So if you can answer yes to those two things, then maybe a position of saying, look, I got what I think is okay, a strategy, and it's good stuff. I'm going to stay the course and not worry too much. So that might make some sense. So we're talking about a lot of things here. So give us a call at 616-301-2581 or go to our website, www.cornerstone-rp.com. Put your name and number and we'll reach out to you. So that's the first set of questions. Second set of questions, depending on how you answer, determine if you should do something. Do I need to take income out of my life savings to maintain my lifestyle? Meaning, am I in retirement? And number two, can I really afford to take a 10 to 15% downturn loss in my life savings? If you answered no to any one of those two questions, then it might make some real sense to sit with somebody to reevaluate your portfolio. Because here's why that's important. If you never have to take money out of your portfolio, you never have to take money out of your life investments ever, you can just invest in a market and let it ride. Because ultimately the market's going to go down, but over the long run, over the next 30 years, they will probably be somewhat higher than they are today. On the other hand, if you need to take income out of your life savings right now, if you have a loss, I'm not talking about 50% catastrophic loss, but a 10 to 15% correction, which would be normal in the market, and you have to take money out of your account at the same time, the impact on your life savings is about the same as if you were drawing water out of a well that's drying up. It becomes a little more frightening, perhaps, and scary because you don't have the recovery time. So you have to answer the question to yourself, where are you in this time and frame, and what's important to you? So ladies and gentlemen, if we've touched on some things that perhaps you need answers for, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and number in there and we'll get to you and answer your questions and help you out.
You have to carefully examine your individual situation and your specific set of circumstances to know the answer of that question, or to that question of what to do in various market conditions. And if you need help, guidance, assistance, would like to review, run an analysis on your current portfolio and get a better understanding of it, that's what Certified Financial Planning Professional Ron Courser, CFP, and the team from Cornerstone Retirement Partners is there for. Give them a call, 616-301-2581, 616-301-2581. Ron, you mentioned the lost decade, that period from about 2000 through about the end of 2010, the first decade of the 2000s millennium. And that is a time that experienced a prolonged period of market volatility. I'd really like to examine that period under three different circumstances. And really, to start this conversation, maybe just two, and then we'll add the third. The first one is, what would have happened over that period had we had $100,000 invested at the beginning of the year 2000 versus the second circumstance where we are adding $10,000 per year to investments over that decade? What would have been the difference there? And what is, in your mind, if you can compare the two, what are the likely outcomes of those two different scenarios? Does that make sense?
It does. And a lot of it depends on the base and where we started from. So let's go back to 2000 and just take the S&P 500. The 2000, the S&P 500 was 1469 on January 1. It's actually, and then 2013, we go to 13 years, the index was 1469. So the S&P 500 index didn't go anywhere for 13 years. Now, no matter how you do the arithmetic, no matter how you crunch the numbers, that means you didn't make any money in the market. If you had just an S&P 500 index fund, you broke even. But did you really break even? Because we had 13 years of inflation, sometimes low, but still inflation. You may have been paying taxes on some of that money that was in a taxable account. So it's quite possible, when you really do some serious number crunching, that if you just invested in a simple S&P 500 index fund, you came out a little behind the ball. Now, what would have happened if during this time you invested? And that's a concept called dollar cost averaging, isn't it? It's what people did if they were still in their 401k plans. So when they started investing on the 1st of January 2000, the market was high, it was peaking. It didn't really peak until March. And then it started a slow downhill collapse that ended up with 9/11 and all of that. If you would have kept putting in money on a systematic basis, and I'd have to crunch the numbers, you have more money today over and above what you put in. You bought a lot of shares when the market was going down, 2000, 2002. You bought fewer shares when the market was going up, 2003 to 2007. But the cheap shares you bought before then were increasing in value. Then we had that giant collapse, depending on what kind of assets you own. You see, this is another question. It's just not saying, well, okay, I bought the S&P 500. That's simple. But what if you owned other kind of assets? What if you owned real estate at that point in time? Your losses in real estate after 2007 may have been much greater than the market losses. But let's just keep it simple. You had an S&P 500 fund. So dollar cost averaging, the people who were still investing, whether they were putting $100,000 into it there and $100 a month, or $10,000 a year, however you want to do it, they'll have more money. Mathematically, they will have more money. Now, what happens if somebody retired in 2000? Interesting question, isn't it?
Mm-hmm. And I want to talk about that scenario in just a moment, Ron. But in light of what you just described there, the difference between existing money and new contributions, I want to take a moment and talk about this age 59 and a half opportunity to do that in-service distribution. And if we have reached or passed that milestone and we've got existing money, and we're also making ongoing contributions to retirement accounts, should we handle those dollars differently? Is in your mind, is there an advantage to potentially examining the approach of existing dollars versus new contributions?
Yeah, there is. It's a great question. And how would I answer that? I'd answer it this way. If your sole vehicle for investing is a 401k plan, you're limited to the kind of investments you have. You generally will have large cap, small cap, mid cap, bonds, mutual funds, and you'll have a stable value fund of some kind or a cash account. That's it. It's designed to go and do well in one scenario, and that's if the markets go up. But what happens if there are other kinds of investing options that are available to you that have interest for you? Then it might be appropriate to take advantage of the in-service distribution option in your 401k or 403b. Convert some or all of that money into an IRA, just transfer it. It's a non-taxable transfer. And then you open up your life savings to a wide world of different investment options. And I'm not talking about investing it all in crypto and things like that, but just other kinds of investing. If you wanted to do strictly buy stocks, it's easier to do that, and you're more likely to be able to do that in an IRA account than a 401k account. If you want to buy investments that have some downside buffer protection, chances are you're going to be better off in an IRA to get those kinds of investments. They're not going to be available generally in a 401k plan. So a lot of it has to do with a really simple question, and a question that everybody has to ask themselves, and it's this: what do you want your money to do for you? If I answer the question, and there's not a wrong answer, I just say, you know what? I don't want to get involved. I don't want to think too much about it. And I just want to save money and 10 years from now, retire. Maybe a good option then is just to use the 401 or 403b, whatever plan's available, put it on kind of autopilot. Just make sure you're putting in regular contributions and hope that the year you retire, the market doesn't correct. If on the other hand, you say, you know what, there's got to be a little more to life. There's got to be a little more opportunity to maybe make money or take advantage of current market conditions outside of my 401k. There's got to be other investment channels, strategies out there available to us. Then maybe it's appropriate to go and say, I'm going to move some of that or all of it into an IRA, where with myself or another advisor, we can manage it appropriately with strategies that make more sense than what's available to me in my 401k. Does that make sense?
It does. It does. And I think that is where we take our individual set of circumstances, our scenario, and we figure out within that set of circumstances what the right approach is for each and every dollar. And different dollars may have a different approach, but at age 59 and a half, we have a big opportunity if we are like the majority of Americans and the majority of our savings is being done in a 401k. That may be a particular milestone where some amount of action and change in approach could potentially be appropriate, and we can differentiate between existing dollars, the life savings that we have accumulated up to that point, and then the ongoing life savings that we will do subsequent to age 59 and a half. And here's the key, ladies and gentlemen, is that at age 59 and a half, the majority of 401k plans now do allow you to take control over those dollars. And if you want to find out how to do that, how to go about it, where they would go once you take control, that's where you speak with a financial professional. In this case, Ron Corser, your resource, CFP, a certified financial planning professional, founder there at Cornerstone Retirement Partners, can run through a risk profile and investment analysis, and then can make suggestions proactively of your ongoing allocation and recommendations with that fiduciary responsibility to your best interest. So pick up the phone, give them a call, 616-301-2581. That is 616-301-2581, 616-301-2581, and request your course to retirement, that proactive review and strategy session, and then the outline of that plan being put together so that you can discuss how and where each dollar can be appropriately positioned. 616-301-2581, 616-301-2581. We need to take a quick break here on Your Course to Retirement, but when we come back, let's talk about turning that corner, charting a new course through retirement, and what market volatility means when we begin making withdrawals. What if we had retired at the beginning of a volatile market? How would that impact our retirement outlook? That's when we come back here with Ron Corser, CFP, on Your Course to Retirement in just a moment. And welcome back to Your Course to Retirement, your weekly program with a dose of common sense about the market, about your money, about the economy, from the perspective of a certified financial planning professional. Ron Corser, CFP, Grand Rapids, your resource for guidance with your dollars to make sure that each and every one of them is working its hardest to help you achieve your important financial goals. The founder of Cornerstone Retirement Partners, he's got a team there looking after your wealth and your health with that team approach, helping you plan proactively for your important financial goals. And today we are talking about the realities of the market that we are facing. We are seeing some volatility that we have not seen in quite some time. The last decade has been fantastic, and many of us have grown and appreciated the opportunity for growth presented by the market. But we are seeing that the market has, and probably will again into the future, had periods where it has been volatile. So what's the reality of these down times in the market, and what should our approach be? Well, that's why we turn to the guidance of Ron Corser, certified financial planning professional, CFP, and get his take. Now, Ron, during the first part of the program, we talked about two different scenarios, and we gave the example of the lost decade. What would happen if we began the decade with $100,000 and then went through some volatile times? And then what would happen if we added money proactively, maybe to the tune of about $10,000 a year? That's $100,000 as well. What would the end result be with those two different scenarios and situations? And we concluded that maybe if we've got an existing life savings, it might make sense to take some control of it during or before periods of volatility. But if we've got that ability, to certainly consider it. Wanted to talk about turning a corner to maybe a third scenario where we are actually in retirement and living off of our money, and what difference that makes.
That is a huge deal breaker for people. And it's really important to understand that once you stop working, you don't have an employer that's giving you a paycheck every week, every month. So now all of a sudden, guess who becomes your employer? Your money. You know, they say, don't fall in love with your money, but all I say is learn to like your employer, because it's your employer that provides you the ability to get by month by month. So your life savings becomes your new employer. So what is the biggest risk to that employer? Well, just like a regular employer, that they'll go out of business. That means that you lose all your money. But people don't ever lose all their money. I've never met anybody in 26 years in this business that's lost all their money. I have met some people that have lost an enormous amount of money. Wow. I mean, it totally destroyed the retirement plan. but I never met anybody that went down to zero. But in retirement, you take on a new kind of risk. You know, when you're working, the biggest risk you have is, you know, I call it is disability, not being able to work before your full retirement age. When you're retired, what's the biggest risk you have? It's not disability, although that can be certainly a money drainer. It's having the experience of a bad market 2, 3, or 4 years in, beginning retirement, or 2 or 3 years before you retire. It's a red zone, we call it sequence risk. It's the risk of losing money 2, 3, 4 years before or after retirement. I'm not talking about a 50% loss, but it's a loss, 10, 15%, whatever in a normal correction. And now you're starting to take money out of that account. Sequence risk is something that you don't know it's hit you until after, way after the fact. Let me give you a great example of sequence risk. The guy who owns our building, one of the things he does is they go to Africa every year and they do some ministry work there, bringing basically water purification systems to the folks. And about 10 years ago, he talked about, he said he got bit by a bug. Imagine that. He went to Africa and he got bit by a bug on his ankle. No big deal. Everybody gets bit by a bug. Well, about 3, 4 years ago, he got up one morning and his ankle was red and it hurt. And of course, his wife said, you maybe ought to go see a doctor, but he's a guy. He's not going to do what his wife said and go see a doctor. So he said, it's going to be all right. So the next morning he got up, it's bigger, redder, hurts more, and he's starting to limp. And she says, you know, you really ought to go see a doctor about that. Now I'm going to be okay. He said the third day I got up, he couldn't stand on it. It was puffed up like a beach ball. He went into the emergency room and he was there most of the day. They pumped him full of antibiotics. And basically they said if he'd have waited about one more day, he'd have lost his leg. So what's the story tell you? Something happened 10 years ago. Seemed like it's no big deal, but the impact of it was felt 7 years later. That's what sequence risk is like. You can take a loss in your life savings 10 years ago, 5 years ago, and it's going to be okay because you still got money, you're still taking money out. And then all of a sudden, that loss that you took rears its ugly head, and somebody says to you, you know, if you keep drawing money out at the current rate, you will run out of money in the next 10 or 12 years. Sequence risk is a terrible risk. It's a risk that not a lot of advisors talk about. We talk about it all the time, and you can plan for it. Not that it's going to happen, but if it happens, you plan for the fact that you're going to do one thing that is really great to avoid sequence risk. You're going to make as much of your income in retirement permanent or predictable or safe and guaranteed as you possibly can. That includes Social Security, pension plans, the use of income annuities. We use that a lot because the principal is protected on them and they provide great streams of income that don't change no matter what happens in the market. So if you can take at least those 3 streams and maybe develop a 4th stream of predictable income, that is a great way to buffer yourself, protect yourself against sequence risk. Because why is sequence risk a risk? It's a risk because you may have to adjust how much money you're taking out of your life savings because you had a loss and you don't want to run out of money. But if you reduce the amount of income you're taking out of your life savings, maybe that's going to impact your lifestyle. So the key to sequence risk, the whole key to successful retirement planning is to create as much predictable, permanent cash flow month in, month out that you can with your life savings, including Social Security and pension, so that no matter what happens in the market, no matter what's going on this year, your income is never going to change. It's never going to fluctuate. You're going to be able to do everything you want to do and not worry about, oh my goodness, am I going to run out of money, or is this market going to really hammer me?
Again, if you would like help constructing such a plan. That is one of the biggest things that they do there at Cornerstone Retirement Partners, is help to construct the plan, looking comprehensively, holistically, looking at what your needs are, and then designing the plan to address those, and then discussing what are the best tools to most effectively help you achieve the goals that that plan helps to identify. 616-301-2581 is the number to call. 616-301-2581. By the way, they offer the opportunity to begin that conversation and really dig into the details on a complimentary, no cost, no obligation basis. That initial review strategy session, you can call and request that time, set it up at a time that is convenient to you. You can conduct that in person or virtually. You can do a lot of it over the phone, or just ask a few initial questions that you would like answers to over the phone. 616-301-2581, 616-301-2581. Ron, if we are at a point in our progress and in our lives and with our money that we don't want to see another dot-com bubble burst or 2007, 2008 type of great recession that we have to go through, that we encounter, there are alternatives to the market. And you know, in giving both of those as examples, the market is about 3 to 4 times higher than it was during those periods. They say the bigger they are, the harder they fall, the higher the market is, the further it seems to fall. So if we want to look at alternatives, if that is just something that's not appealing to us, there are options out there and available, and you have access to them and can help educate people that they don't have to risk their life savings and their financial future on the direction of the market.
You know, I think, and I've been doing this for 26, going on 27 years, and I think one of the great disservices my profession does is that we exclude certain kinds of assets and asset classes because A, either we don't like them, or B, we don't understand them, or C, if we use them, we don't get paid for them. As a fiduciary and as a fiduciary firm, we have to make sure that we don't walk into a situation with a brand new client or an existing client and say, you know what, there's just certain things we're not going to show you or talk about because we don't like them or we don't use them, and too bad. We don't do that. I think that's incredibly wrong. I really do. It doesn't mean that there aren't a lot of advisors out there who take that position. It's just not one that we do.
And Ron, as an example of that, I know that you do not manage rental properties, but if somebody walks in there with a portfolio of maybe 10, 15, 20 rental properties, is the immediate reaction from you going to be to sell them all because that's not going to be the best thing for their financial future?
We have clients that have rental properties, and it's a great stream of income. Remember I said about 5 minutes ago, that could be the fourth stream of income.
Absolutely.
Yeah, it's a great retirement income if you know how to do it. Some people use a management firm to do it. I can't do rental income properties because I don't know how to fix anything. And so I'd have to hire a plumber every time something went wrong. So when I invest in real estate, I do it through other means, investing in real estate to get the tax advantages. But there are a lot of people who are good at it, and a lot of people who like it. That's the real key. We have clients that really like investing in real estate and managing a real estate portfolio, and I applaud them, and we include that in the planning that we do. It's just part of the program. Just because I don't do that doesn't mean it's not something I should not help them with. As a fiduciary, we take a pretty wide view of everything. So that's one of the great income producers for it. And sometimes it's right for people, but it's not something you dabble in. It's not something you say, well, you know, I'm 69 years old. I got some extra money. I think I'm going to go into house flipping. If you were going to do that, Peter, I'd probably say, you know what? I can't stop you from doing it. But my opinion is that's not a good idea because you've never done it before and you don't understand it.
I've often equated it, Ron, to Newton's laws of motion, that objects in motion tend to stay in motion. And objects at rest tend to stay at rest unless acted on by an outside force. And man, does it take a lot to get momentum built up. So if you're used to it, if it's already kind of going, fantastic. But if you're not used to it, if you don't understand the momentum the force that it takes to build that momentum, then you may not want to jump all in on that ship.
No, you really don't want to. You need a mentor, somebody to help you along with that. So yeah, that's a great example of just saying, that's very appropriate for you. You understand it, you've done it, keep doing it. I mean, I got one client, he's an Army buddy. He's got 5 pensions. He's done very well in retirement income planning, but he has 3 rentals in the Washington, D.C. area. And it's a gold mine. It's an absolute gold mine. He could raise rent every month and people would still stay there. So it's a great source of income for him, and he understands it and he does it. There's a lot of things out there that people could find some interest in, but might be appropriate, but they need somebody to help them through it. Another kind of investment strategy for income producing, and this is something that a lot of advisors may use, is using a dividend, stock dividend or preferred stock dividend portfolio for income. Might make some sense, particularly preferreds, because some preferreds pay a very nice dividend or distribution, and they're great income producers, and they don't have an enormous amount of market volatility generally. They can still have it, but they don't generally have it. So that's another approach to use. The third approach, and one we use a lot with our clients where appropriate, is principal protected fixed annuities. I know there's a lot of stuff out there. I hate annuities and things like that. But I had a client come in yesterday and he said, I listened to your radio program a while back and you spent the whole hour talking about annuities. And so I said, well, you spent the whole time and you said you're mad at me? And he said, well, I was on my way to church and I listened to your whole program and it caused me to go to church late. So I said, it wasn't the information. He said, no. He said, I bought 2 annuities from you and I remember kind of giving arm wrestling a little bit. He says, I wish I'd have bought more because they're providing the income I need now and my money's safe and protected. And I said, well, you did well with what you did and your whole portfolio is still working. That's the approach we take. There's nothing out there that I see that says, oh my goodness, get away from the cryptocurrencies as a long-term investment strategy and those kinds of things. There's not a lot out there that I say we should never look at because it may be appropriate for somebody. It may be useful for somebody. They may understand it and like it, and it may fit into their overall retirement plan. So ladies and gentlemen, if you'd like to have what we call a comprehensive, but a really nice conversation about what you've done, where you're going, does it still line up with what you want to believe is going to happen? Does it make sense for your future, your family's future? Give us a call, 616-301-2581, 616-301-2581, or go to your website, www.cornerstone-rp.com. Put your name and number, and then we'll get to you as quickly as we can to help you out.
616-301-2581, 616-301-2581. Ron, looking back, wrapping up the month of April, the last full month that we have, and really even then leading into May, we're seeing this volatility. I mean, April across a few of the indices, which ones you look at, was the worst month since 2008. And then the Fed continued with their direction in raising interest rates. And I don't think volatility is going anywhere anytime soon. All that being said, we are still far, far above where we were even as close back as like 2019 or 2018. We have still made financial progress. So looking at the numbers, we are ahead. And what if at this point in time, we don't want to continue on the market roller coaster? Are there reasonable alternatives where we can have some safety and security of principal? And if so, given the fact that rates are on the rise, and that's what we're hearing about, what could we expect for a reasonable rate of return on something where we don't have market risk?
Well, you used an interesting word called expect. And one of the key issues as an investor is our expectations. Let me give you an example. You walk into a casino for $10,000. You expect that this time it's going to be different.
Do we though?
Walk out
Do we
that
expect that?
10,000 plus a whole lot more. Your expectation is set very high, and you're going to go after it with a sense of gusto and purpose. But sometimes the high expectations lead to disappointment. And the casino once again won, and they weren't supposed to. The other approach is to say, you know what? I'm going to put all my money in the bank, and maybe they'll give me 1%. My expectation is maybe 1%, but I'm going to keep all my dollars. That expectation will probably be met. And there won't be that, oh my goodness, I missed out on something or I avoided something. So a lot of investing has to do with your expectations. Sometimes I try to help people understand you can expect a 10% rate of return. You can try to create a strategy that will give you the best opportunity to succeed, but there's no guarantee. So if you expect to make 10 and you make only 5, should you get mad at me, the advisor, or should be content to say, you know what? We made money in this market. So having set expectations before you ever kind of dive in, so to speak, into market investing is very, very important. If you have high expectations and they're not met, the stress level will increase. Believe me, it will go up like the thermometer in the middle of July. So expectations are key. I just tell people, first figure out what you want your money to do. And that might be something as sophisticated as the following. I want my money to generate an extra $2,000 a month in investment income and income to me so that I can maintain my lifestyle based on pension and Social Security money. And that $2,000 a month or $24,000 a year might be 3% of the portfolio. So if we could get, in a worst case scenario, if we could get 3% and you got the income you need, would that be a bad thing? Most people would say no. But then there's that part of human, we're all human, God created us this way. If a little bit is good, a little more is even better. You know, they once asked one of these great corporate raiders back in the 80s when he was taking apart a great airline. And they asked him, they said, how much is enough? And he said, you know, just a little bit more. So we have that tendency to be sad when we could have gotten a little more if we'd have been a little more aggressive. But the flip side is we get terribly hurt if we get less because we were aggressive and the market didn't perform, our strategy didn't work. So expectations are really important. Having a goal that makes sense based on your expectations is critical to giving you the best chance for peace of mind in a volatile market. So ladies and gentlemen, if you're looking for some peace of mind and maybe somebody to talk to kind of sort through all the craziness, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name in there and we'll get to you as soon as we can to help you out, to answer your questions, provide the information you need, do whatever we have to do to give you that thing called peace of mind, which is so precious today.
616-301-2581, the number to call, 616-301-2581. And Ron can help you review and evaluate all options that are out there in the financial world and construct a plan that makes sense to help you achieve your financial goals. 616-301-2581. The important factor here is that fiduciary responsibility to a client's best interest, making sure that your goals and objectives, your best interest is served first whenever the plan is constructed, whenever recommendations are made. 616-301-2581. Ron, we spoke about real estate I'd like to turn the corner here as we wrap up the program to another option that we're hearing a lot about: inflation. And we know that inflation is real, and the government has indeed recognized that and acknowledged it with their inflation-backed I bonds. These are, as much as anything can be in the financial world, basically as safe and guaranteed as possible, backed by the full faith and credit of the U.S. government. Can you talk to us about this announcement that I bonds reach a record of 9.62%, where we can get a safe 9.62%, and is that an appropriate option to consider? What do we need to know if so?
Isn't it amazing? Isn't it amazing this time? I'm glad you brought it up because we are recommending those to our clients. Now, you have to do it as an individual. You have to go to the Treasury website. We can't take your money and invest it on our platform. It has to be done directly, but we're helping clients actually do that. You can do $10,000 a person. You have to hold them for the first 12 months. Can't sell them. And then you really should hold them for another 5 years. But if you want to sell them after 12 months, you just give up 3 months interest. And it's a great place. If you have some money laying around, inside of a shoebox at home, because you didn't want to put it in the bank, this is a pretty good option to take a look at. You can give us a call because we're helping our clients do it and anybody else who calls in. In fact, we put out an email detailing everything about I bonds to our clients 3 weeks ago. And the response has been really great. So give us a call, 616-301-2581, 616-301-2581. We can help you if this I bond issue has got something that interests you. We can help you with it. It's what we do. We'll show you how to get online, show you how to do it. I think it's a great option for certain people to do certain things. You don't pay state or local income tax, only federal income tax on it. It's a pretty good option for saving, particularly in the environment we're in right now. And because it is a government treasury bond, basically, you can say, yeah, it's guaranteed, which is kind of nice. The interest rates can change. There's a fixed rate part and then a variable rate part, but as long as inflation wants to keep rearing its ugly head and interest rates go up, this would be a great way to save for a portion of your cash dollars. Give us a call, 616-301-2581. See, that's what goes back to, I think, what separates us just a little bit. We're not adverse to saying, hey, take some of your money and put it over here. We think it's a good idea. We don't get paid for it, but it's what we do to service and to help people. It's all about the whole fiduciary idea of being, open and doing what's in the best interest of people, but it's also doing what's right for people. So give us a call, 616-301-2581. 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and number in there and we'll get out there and help you.
Isn't that so typical of the government, though, Ron? When they do give us something good, they give us something that we'd like to take advantage of, they limit how much we can take advantage of it. They don't let us do too much in it. Kind of like that Roth IRA. It's a fantastic opportunity, but you can't get much into it.
Yeah. Yeah, the government giveth and the government taketh away. Blessed be the name of the government. Yeah. But, it's nice. I guess you could call it a crumb. And it's nice to have some of those crumbs. Will things change over time? They probably will. But when little opportunities like that come up, take advantage of them if you can. They're great savings vehicles. And we try to help people understand that there's always a place to go somewhere where the possibility of having a positive rate of return exists. It's not all or nothing. There's always a place to go where the potential of a return exists. And we try to help folks move in that direction as long as it's appropriate for them and it lines up with their investment goals and values.
Well, we always appreciate your candor, your insight, and the prudent guidance that you provide here on your course to retirement. Ladies and gentlemen, if you would like to speak with a certified financial planning professional, Ron Courser, CFP, and the team there at Cornerstone Retirement Partners are your resource. Give them a call, 616-301-2581, 616-301-2581 for individual guidance and recommendations with that fiduciary perspective, putting your best interest first. 616-301-2581. They can give you guidance based on your specifics and your situation on what to do with each and every dollar so that it is working its hardest to help you achieve your important future financial goals. Again, you can go online, cornerstone-rp.com, cornerstone-rp.com. Plenty of great resources there, but the best way to get in touch and have that conversation, just give them a call, 616-301-2581. Ron, as always, appreciate the conversation and the perspective on what we're facing here in our financial and economic world.
I've enjoyed today, ladies and gentlemen. Have a blessed Memorial Day. Remember why we celebrate Memorial Day, and then enjoy time with your family and the blessings of God. Talk to you next week.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the products featured